Hey everybody, all right, I'm going to talk through the hard money loan workflow. Just kind of walk you through the stages. We have a simple document. We'll make sure we share that and it's available to you as well, so you can kind of reference this as a guide. We'll make sure it's shared within the Trainual kind of platform as well. So very simple kind of workflow if you think about it. For anybody that's getting a hard money or trying to do a hard money loan, the first step would start with a borrower inquiry, right? So you've either got a referred in customer or somebody in your sphere that was reached out to you about getting a quote on financing or like a fix and flip type of loan, and just wanted to start with that. So the first thing you want to do is send them to our application. That is actually on our site at hardmoney.com or matadorlending.com/hardmoney. And then they can actually just create like a normal kind of workflow to input their information. So the minute they do that, they'll be pulled into our mortgage automator, which is the CRM/LOS that handles, it's kind of like the lending pad of hard money. So as the minute that happens, they'll come into our system like a application here. And I'm going to use this loan file as an example, but basically as they start to input the address and et cetera, loan information that they're looking for, that'll start to input here. Now, they may not have a property address in place yet. If that's the case, then they just put in their basic information. And then the next step is we're building out where you can run credit within inside of Mortgage Automator. But if that's not available or not ready yet, then you can just go to Advantage Credit and pull a one-off credit report just like you would standalone for a customer. You don't have to create a whole new loan file in Blink and or in Lending Pad to do that. You can literally just go to Advantage Credit and run credit. Then the minute you have that, we'll be able to pull in a copy of their credit report in here. If the integration was done, then it would pull in automatically. And then you want to kind of start gathering up the standard documents for a borrower. We're a little bit more excessive on the front end. So you go to your standard documents of bank statements, W-2s, tax returns, et cetera, et cetera. You don't necessarily need all that, but it's kind of like us trying to get to know the borrower on the front end. So that way that we can kind of confidently lend to them over and over again. Then if they have a property address, then let us know and we can start to do the analysis there. They'll let us know the type of loan that they're looking for, whether it's a fix and flip. A bridge is kind of a short-term loan to be able to buy it, and then they would immediately refi us out, or a more of a long-term 30-year fix like DSCR type of loan. We can accommodate any of those. We can also do construction loan applications through the system, but just kind of get clarification of what those are. Based on that information, you should be able to give them preliminary rates and fees. There is a rate sheet that we'll start publishing to you guys, so we'll have that as a separate attachment or a link that you can go to. But your standard kind of normal, at least at the time of this video, is 2 points and 12% interest only. And then we have like a $6.95 admin fee that may be subject to change, also based on the borrower's, like credit or whatever the case may be. Those rates may slide up and down. And if they're like a repeat customer, then we may have more competitive rates for them. But for now, that's kind of the baseline. So you're going to send that information to the borrower and just kind of create a basic like term sheet for them. And if they're good, they can actually sign it and acknowledge that they agree to the term sheet. You want that to happen before we start doing a lot of busy work on the loan. So make sure they're good with the terms. If they are, well, then we can start kind of working through the rest of it. So then we can send them a pre-approval or a proof of funds based on them accepting our terms. But once they do that, they can go out there and start, either get under contract if we're already about to, or go shopping for kind of that next opportunity and then come back to us when they're ready. Once they're under contract, then we kind of start back into the normal workflow. So you're going to open title, get title information, a title commitment back. Our doc attorney needs a copy of that before they can issue it. Have them start shopping for homeowners insurance. If it's like a true big rehab, it's called builder's risk insurance. If it's a kind of standard, like ready to go property, then it's a regular homeowners insurance policy. We'll go ahead and order the appraisal. So that's either going to be an ARV appraisal if it's a fix and flip. So we'll get, the address and contact information to, as well as a copy of the contract to do the inspection. But then also we'll need a scope of work. So that'll be like, hey, I'm going to do $20,000 worth of rehab. I'm updating the kitchen or whatever the case may be. So we need that to be able to get the ARV. And in rare circumstances, if it may be a very low LTV loan, we may accept a BPO, which is called a broker price opinion. So we're going to go ahead and open title. So we're going to send instructions to the title company. We need a copy of a clean title commitment for our attorney to go ahead and gather up docs. We'll go ahead and order the appraisal. Well, it's called an ARV appraisal in most cases when it's a fix and flip. So to be able to do that, we'd obviously need a copy of the contract. We need to go ahead and know the right contact people to schedule it, as well as we need a scope of work. And that scope of work is like, let's just say it's a $20,000 fix rehab that they're putting in to upgrade the kitchen. Well, we need that outline from a third-party contractor to be able to let the appraiser know that, hey, this is what they're planning on doing. What's the value based on that happening? In rare cases, if it's a very low LTV loan, we may be able to get away with what's called a BPO, or a broker price opinion. So in that instance, we would just need a simple third party, typically a realtor, will like run comps, and they'll let us know that they think the value based on based on the rehab will be X amount. We'll go ahead and shop they'll also start shopping for homeowners insurance. So that's like your standard homeowners insurance policy. If it's like a 30-year fix and flip, then that's a regular policy. If it's kind of a extensive rehab, then it's called a builder's risk policy. But ultimately, we're covering the loan amount at minimum in either side. We'll reach out to the title company. We'll send them preliminary instructions from us that kind of outlines our fees, as well as kind of the nuances of the loan, and then we'll let them know, where our wiring instructions or we'll get their wiring instructions, apologies, to kind of go ahead and wire our funds over, and then we'll preliminary schedule a closing. Most of these loans are usually like 2 weeks or less, so this all happens very quickly, so we can start scheduling a closing. And then the title company will actually send us a copy of a preliminary settlement statement that we can start to confirm all our fees, any payoffs, et cetera, that may be associated with it, any assignment fees, if it's like a wholesale deal, all that stuff is kind of starting to button up. Then usually within a day or two prior to the close date, we'll have the attorney confirm the docs are going out. We need to get those sent over to the title company. They'll review and just make sure that they're good to go to confirm our closing. We'll wire our funds the morning of closing, and just kind of make sure. In our instances, we need a fully signed loan package back before we're allowed to release funds or like authorize funding. So once we get that back, then we'll kind of deploy the funds, and it's actually a pretty simple process. And then that's actually, the final stages of a true funding. And then in Mortgage Automator, it's actually a servicing platform. So let me kind of go back to that in terms of what it would look like when the application comes in. But we would actually start to collect payments through the system. So real quick, I'm going to take a step back and I'll go through just the baseline of kind of what the loan terms look like. But the most important thing in Mortgage Automator is the customer's loan documents. So in here, we can add and remove any type of loan doc that may or may not be required. So the standard ones we would need from a customer is their insurance, like I mentioned, bank statements, a copy of their ID, a survey of the property if they have one, tax returns. This is entity docs, so you've got an operating agreement, an EIN number, and articles of incorporation. And you can add and remove anything from the borrower's portal. And then right here, there's a link to the borrower's portal, which will actually open up this. So this borrower's information is here, and they can upload directly whatever they have. And in some cases, they may not be the ones providing it, but it's a nice, clean link for them. We will have some automation built in here where it'll send out emails on our behalf and things like that. But for now, this is kind of the standard, off the shelf build out of it. Also in here, you can see, if you click on preview, you can see kind of a templatized fees table. See, it's not actually pulling anything in yet. So we'll have that built out, but then also a term sheet that we can send out to the customer will be established here. This is also a canned one that we'll have modified and ready to go. But you can play around with some of that stuff. So I think the deal worksheet is here. Yeah, this was the deal worksheet, I'm sorry. So you can see kind of the terms and deal information that we've got. That's pretty much it. And then from there, like I said, post-closing, our team will start picking it up on the servicing side and collecting payments and things like that. But it's fairly straightforward. It's a very simple loan from start to finish. It moves quickly. The main thing is getting that appraisal back, and we just scrutinize and make sure that everything looks good. And the borrower's credit and kind of just lendability to the borrower standpoint is what we're looking for.